Hello everyone, welcome back to the Biz Time YouTube channel. This is Stock Market Weekly. The stock market was a bit shaky last week, showing signs of volatility. The all share price index closed at 20,612 points, losing about 380 points. That's a 1.8% drop from the week before. The S&P SL 20 also moved lower, sliding by 118 points to finish the week at 5,886. On the foreign investors side, activity stayed strong. Foreign purchases came in at around 1.9 billion rupees, but sales were much higher at 4.3 billion rupees. That means we saw a net outflow about 2.3 billion rupees from foreign investors over the week. Since the Colombo Stock Exchange has been going through a short period of volatility, we thought it's the perfect time to bring you an important concept of portfolio diversification. One of the main goals of diversification is to minimize risk by spreading your investments across key assets and sectors. Investors usually face two types of risk: systematic and unsystematic risk. Systematic risk, also called a market risk, is the broader kind of risk that impact entire markets. Things like economic recessions, geopolitical tensions, or global crises. The key point is this risk cannot be eliminated through diversification. Unsystematic risk, on the other hand, it is more specific. It is tied to a particular company or industry. For example, labor strike, poor management, or even supply chain disruption. The good news is this risk can be reduced by diversification across different assets and sectors. The bottom line is simple. Diversification can't remove market-wide risk, but it can protect you against company or industry-specific risks. So let's take a deeper dive into diversification and explore why it's such an important part of smart investing and risk management. What exactly is diversification in investing? Diversification is simply a process of spreading your investment across different asset classes, industries, and even geographic regions. The goal is to reduce overall risk in your portfolio. Think of it this way. If an investment performs poorly, the loss can often be balanced by stronger performance in another, giving you more consistent overall returns. The key idea is to combine assets that are not highly correlated with each other. For example, stocks and bond doesn't always move in the same direction, but it also important to note diversification does not guarantee against losses. It can reduce certain risks, but it can't eliminate risk entirely. The right mix of investment depends on your risk tolerance, time horizon, and financial goals. But generally, a well diversified portfolio often includes equities, fixed income assets such as bonds, real assets like real estate, or commodities such as gold, cash and cash equivalent, and sometimes alternative investments like private equity or hedge funds. In short, diversification is about balance, spreading your investment so that no single bet can sink your portfolio. For example, let's say you have $100,000 to invest. Now, if you put all in stocks, your potential return could be high, maybe 15 to 20% a year on average over the long term. But here's the catch: the risk is also very high. In a bad year, the value of your portfolio could drop by 30 to 40%. On the other hand, if you put all in bonds, the risk is much lower, but so are the returns, maybe only 6 to 8%. And don't forget, inflation can eat into those gains over time. So, what does the rational investor do? The answer is balance the portfolio. For example, you could split your $100,000 like this: 50% in stocks spread across large cap, small cap, and international markets; 40% in bonds, a mix of government and corporate bonds; 10% in real assets like real estate, investment trust, or even gold. This way, you are not putting all your eggs in one basket. Stocks give you growth, bonds give you stability, and real assets help protect against inflation. Together, they create a much smoother ride for your investment journey. Now let's see how diversification actually reduces risk. Suppose the stock market crashes by 30%, your $50,000 in stock could drop around $35,000. But here's the good news: your bond and real assets may hold steady, even rise. That means your total portfolio would be around $85,000, a 15% loss instead of 30%. If inflation rises, the stock and real assets often increase in value, while bond may lose some grounds, but overall portfolio still stay balanced. And if the economy grows strongly, stock usually climb while bond provides steady income. The results? You get both growth and stability working together. An investor's risk profile often decides their investment mix. A risk-averse investor, someone who wants stability, would have a portfolio with a higher percentage of low-risk assets, like bonds or cash, and smaller share of high-risk assets like stocks. On the other hand, a risk-seeking investor, someone chasing growth, would flip that mix, holding high-risk investment like equities, real assets, and fewer low-risk ones. Balanced investors mix moderate risk stocks with safe options. In short, you balance risk by not putting all your eggs in one basket and mixing assets that react differently to the market events. Let's look at the advantages of diversification. First, it reduces risk across portfolio by spreading investment. Second, it can increase your risk adjusted return, giving you better long term results for the same level of risk. Third, diversification helps preserve capital, which is especially important for retirees or older investors. Fourth, it also opens the doors to better opportunities because you are exposed to different sectors, regions, and asset classes. And finally, for many investors, diversification actually makes investing more fun. You get to explore and research new opportunities. Disadvantages of diversification. Number one, generally leads to a lower portfolio-wide returns. Number two, may cause investing feel burdensome, requiring more management. Number three, can result more and larger transaction fees. Number four, do not eliminate all types of risk within the portfolio. Number five, may return your attention away from larger future winners. Number six, may be intimidating for inexperienced investors. That's a quick look at how diversification impacts investing. In our next episode, we'll explore the global industry classification standards and why it's important for diversifying your investments and managing risk. We have lined up a series of educational videos to help you upskill and make more informed investment decisions. Stay tuned. We would love to hear from you. Comment below and tell us what classes of asset you included in your portfolio. Remember, always invest carefully and do your own research. That's it from Biz Time for today. If you found value in this video, hit like, subscribe, and stay tuned for more market updates and insights. Thank you for watching. See you in the next one.